The first quarter GDP number has come in at 13.5%, which is lower than street estimates. They were standing at 15 to 15.5%. They are also lower than the Reserve Bank's projection, which was 16.2. Now, if you adjust this lower Q1 number into the RBI numbers, the RBI's full year forecast arithmetically should fall from 7.2 to 6.7%, and many economists have already brought down their forecasts. But let me give a different interpretation. At the outset, a 13.5% GDP growth over 20% last year Q1 doesn't look all that bad. Let me explain why and what looks weak. The actual Q1 GDP is 36.85 lakh crore, which is only 3.8% higher than the pre-COVID number, of FY20, the first quarter. The weak elements are: one, construction. Construction GDP has come in at 2.62 lakh crore. It's a good 16.8% higher than last year. But if you compare it to the pre-COVID level, then in 3 years, the growth is just 1.1%. Likewise, another huge category, trade, hotels, transport, communication and broadcasting. A large segment, its GDP was 5.59 lakh crore in the latest Q1. It is 26% above last year, but 15% below what it was 3 years ago, that is FY20 Q1. And these are the two sectors that comprise, the small MSME units, your Udupi hotels, traders, unorganized labor. Okay, now what are the strong points? Private final consumption at 22 lakh crore is 26% above last year and a good 10% over the 3-year-ago level. Not bad at all. And capital formation, gross fixed capital formation has come in at 12.8 lakh crore, which is nearly 7% above the 3-year-ago level. Not spectacular, but at least not all that bad. So what more does this Q1 number tell us about the hidden weaknesses and strength of the economy? Is there strength in domestic consumption, which I pointed out, strong enough to improve the coming quarters? Or will the coming quarters be worse off because of the global slowdown? For all these questions, I'm joined by an eminent panel: Abhishek Upadhyay of ICICI Securities, primary dealer; Pranab Sen, the former chairman of the Statistics Commission; Samiran Chakraborty, chief economist, Citi India; and Rob Subramanian, the global economist of Nomura. Gentlemen, thank you very much for your time. Rob, let me start with you. I mean, it's a great year-on-year story because, we had a terrible first quarter of FY21. But this weakness over the 3-year-ago level, is this an Indian phenomenon or are you seeing it everywhere? How do you interpret this number?
Hi, Lata. It's great to be back on your show. I would say it's not just an Indian phenomenon. I'd say it's an emerging market phenomenon. If you're looking at many emerging markets and their levels of GDP now compared to just before the pandemic, some are still not even back to that level. Some are only just marginally above that level. So emerging markets, much more so than developed economies, have really struggled to fully recover from this pandemic. And I'd say India is in that bucket as well.
Okay. All right. I'll come back to you on the global impact, recessionary impact. But Samiran, I got your note. And you also point out that actually domestic demand is very strong. I pointed out to the personal final consumption numbers as well. If that is so strong, should not the domestic consumption engine be able to propel us better in the quarters to come? Why are you reducing your GDP forecast?
So good morning, Lata. Actually, most of our GDP growth forecast revision is simply a arithmetic exercise because the first quarter GDP came in much weaker than what we were expecting. So we had to adjust for it. If you look at our rest of the year forecast, we haven't changed those forecasts in a very big way, at least in a sequential momentum sense. And part of the reason simply is this hope that the pace of domestic growth momentum would continue in the latter part of the year. Obviously, the big hit for the first quarter GDP was the almost minus 600 basis point impact that came from net exports. And to what extent current account deficit moderates in the latter part of the year and this headwind becomes lesser is going to be critical. If we believe that some of these headwinds remain very strong, then even this 6.7% forecast that we have for the full year, there could be downside risk to that number as well.
Oh, okay. Now that opens a new line of thinking. There are a lot of people. We just have Moody's cutting down growth rates of both global economy, emerging markets, India, US, just about every economy. Dr. Sen, I was pointing out to construction and trade, the large sectors which represent the lower part of the economy, doing so terribly. What is your interpretation? Can that hold back overall growth? Or can this strong consumption of the upper part of the economy continue to propel us?
The consumption pattern is skewed, and that can propel us for a while, but it's not sustainable in the medium term. The question is, how long is the medium term that we are talking about? If we are talking about the next couple of quarters, we may still be okay, but I think after that we should start expecting a falling off until and unless we start seeing a very, very strong response in construction and in the trade, hotels and restaurants sector, which, as you said, are very large sectors for employment. But having said that, I think there was a little bit of exuberance in the projections that were made earlier. If you recall, I've been saying that we should be expecting around 6.5% with a downside risk. And that seems to be coming true. I'm not claiming credit for this. It's bad news, but we really should be cautious about sort of over projecting what the Indian economy is doing. And we haven't yet factored in what is going to be the effects of the tightening of monetary policy.
Yes.
At the moment, it doesn't seem to have had much effect. But sooner or later, it will.
I take your point, sir, and that is going to be my next set of questions. But before that, one more question to you, Abhishek. Any other points from the GDP that we have not yet discussed? And particularly, I wanted your view on, government, whether it can make a difference. Government final consumption expenditure has hardly grown. It's somehow not gelling with the fiscal data we got. It looks like there the expenditure is not bad at all. But do you think those are factors that can propel, like construction, capex, whether any of these can give us an upside surprise?
Well, so the main reason for downward surprise compared to our forecast, which was close to RBI, was the industrial sector performance. So manufacturing, mining sector, the growth pickup in those segments was much weaker compared to what you would expect based on data such as IIP. That in turn reflected margin squeeze faced by this sector because of higher commodity prices. Now, the silver lining is that commodity prices have come off of late, and that should then act on the opposite side and support the numbers in the current quarter and perhaps in the second half of the year as well. On the government spending side, yes, center government spend on the capex side has been strong, but on the revex front has been weak. Also, the states spending has started on a relatively soft note. So, but these segments, you would think that government, looking at the current bond yields, for instance, which are so low, government will have some fiscal space to spend because tax collection numbers also looking reasonably robust. So I would think government spending will pick up both on the revex side because a lot of this subsidy spend tends to be back-ended, and on the capex front because states will spend more in the remaining months after a very weak start.
Okay, fair enough. One hopes that can be a propeller. But Rob, I was talking about these global numbers coming in lower, people cutting forecasts for China, for US, and for the global economy. Will this mean that there will be more headwinds for growth, and will Nomura itself look to lower its India GDP forecast?
So absolutely there's going to be headwinds. We're already forecasting recessions in the US Eurozone, UK, Canada, Australia, South Korea, New Zealand. Many economies now we think are going to have negative growth for the whole of 2023. Let's face it, central banks have been very clear now post-Jackson Hole. They're going to get inflation down no matter what. If that means tightening into recession, so be it. We have an energy crisis in Europe and droughts in other parts of the world. We have China really struggling with its zero-COVID strategy and a property crisis as well. There's a lot of headwinds to global growth. We have minus 1% roughly GDP for the US, Europe next year. There's clearly downside risk to our India GDP growth forecast for 2023, which is currently 4.7%. I think this GDP number that just came out for India, I don't want to sugarcoat it. I think that's as best as it gets. I think it's slowing down from here. There was a reopening, pent-up demand that helped. There was a public infrastructure push. But going forward, I think we're heading to a slowdown, and I think many economists will be revising down their growth forecasts as external factors hit.
Oh, okay. That's not looking good. Saviran, let's talk about net exports, taking from what Rob has said. You point out in your note that actually net exports is one of the reasons why we have done badly. I mean, our imports have done hugely well and exports are certainly not keeping pace. Won't that continue? What is your best hunch?
So obviously, in a nominal sense, the current account deficit number is going to be maybe higher in 2Q compared to 1Q. But post that, we are expecting the nominal trade deficit numbers to start moderating a bit. The question is that to what extent the deflator of this would affect the real part in the GDP, and it becomes a bit technical to understand. The other issue is that if India growth is also slowing down to some extent, the import volumes should also come off, and the relatively whether global growth is going to slow down even faster, affecting our export volumes. That is going to be a critical driver. But at this moment, we have been slightly optimistic in forecasting that for the next few quarters, the headwind from this net exports will not be as sharp as it was in the first quarter.
Oh, really? Dr. Sen, what's your guess? Do you think, I mean, the way in which other countries are getting their estimates lowered, will exports be a bigger drag in the second half? Samiran thinks not.
No, I think Rob was fairly clear about it. Yes, of course, it's going to be a drag. The real question is not what's going to happen to exports. I think that's almost entirely predictable. The real question is what's going to happen on the import side. And the thing is that if we are expecting the overall growth rate to be, even if it's slightly sub 7%, what gives us to think that import growth will come off? I mean, other than the pricing of the commodities. The sense that I have is that we have entered a consumption growth pattern which is import intensive. And that's not going to be changing in a hurry. So my worry, as I said, on exports, I'm not worrying because I think that's inevitable, and Rob was very clear about that. But on the import side, I am less sanguine.
Okay, if imports are going to be strong, then there is a current account deficit issue. Then to what extent will the Reserve Bank be forced to continue to hike rates, because the Fed is also hiking rates and the external sector will have to be defended? All those questions to my guests after the break.